So, hello everyone. Let us start with the topic of the day. Today, we'll understand about the business entity concept principle. Now, there are certain principles of accounting on which the transactions are recorded and the entries are made in the books of accounts. So, you have to understand on what basis you record the entries in accounting. So, very first basis is business entity principle. Now, the most important concept is that what are the different types of accounting principles? That is, first is accounting assumptions, then accounting concepts, and accounting constraints. Now, there are different assumptions and different concepts and different constraints of accounting. Now, if you understand the principles, that is concepts, that is money measurement concept, going concern concept, time period concept, revenue recognition concept, matching principle, full disclosure, historical cost principle, and we talk of the constraints, that is the conventions, that is materiality, conservatism, consistency, and objectivity in cost benefit. Now, let us understand the meaning of accounting principles first of all. Accounting principles are the rules of action or the conduct which is adopted by all the accountants universally while recording the accounting transactions. That is, in what basis you record the transactions in the books and on what basis you prepare the financial statements. There are certain codes of conduct or certain rules of action which have to be followed by everyone, okay, while they maintain the books of accounts. Okay, so this is the most important thing, that on what basis you prepare the accounting statements and record the transactions. This basis is called the body of doctrine. That is, it is defined as a body of doctrines commonly associated with the theory and procedures of accounting, serving as an explanation of current practices. That is, whatever entries you made or whatever practices you use in your accounting procedures and methods, these are defined standardized practices. Okay, they have certain rules, there are certain code of conduct. Okay, and as it is a guide basically for all those who want to actually record accounting transactions and prepare the financial statements. So the most important concept arises in the case where the most important concept is that it is defined as a body of doctrines or the rules of conduct or the rules and regulations, okay, associated with the theory and practices. Now, accounting is both the theory also. That is, anyone who wants to understand accounting and maintain the books of accounts, you should understand both the theory part also, and also that how you actually record them in books of accounts. Now, everything you do in accounting is a kind of a procedure. That is, if you record the entries in journal, it is a kind of a procedure. Then you record the entries in ledger. Then you record them in trial balance or prepare balance sheets or income statement or profit or loss account, or your even the profit and loss statement, the trading and profit and loss account, and also your cash flow statement, your fund flow statement. You determine the procedures of depreciation, you determine the methods of depreciation. That is, there are certain methods of depreciation like straight line method, reducing balance method, return down value method. So which method to adopt in case of depreciation of an asset? It is also a kind of a guideline, that which procedure you should which method you should use for depreciation. Like suppose the different methods of inventory valuation, like LIFO method or FIFO method. Okay, so which method actually use? They all are the certain guidelines on which basis you have to choose your methods and procedures in accounting. That is very, very important. Now, they should be understandable, obviously, explanatory and simple, so that every accountant can actually understand accounting and maintain the books of accounts. They are followed consistently, and that is, consistently here means that the methods or procedure which you are using in your books of accounts, they should be consistent. They should be same throughout the year and throughout the years. Okay. Now, suppose you are using the depreciation method of straight line method. So you should use a straight line method for all the years of that asset. Like suppose you're talking of the asset of furniture. So furniture should be depreciated on the basis of straight line method only for all the years. Okay, it is not that you can change in between the methods. So this is called consistency in your approach, in your methods, in your procedures, in your alternatives which exist with you. In case of, see, alternatives here means different, you have different methods of doing the things. Which method you will choose, you should stick to that method only. You stick to that alternative only. Okay, Now, able to reflect the future predictions. Obviously, whatever accounting you are preparing right now, they are actually made with the reflection of future predictions only. Because whatever you are recording the books of accounts, they will tell you about your profit and loss situation. They will tell you about your sustainability in the future, and it tell you about your actually growth in business. So they are prepared keeping in mind these points. Okay. Now, if we talk of, let us understand now. Okay, suppose let us understand the business entity concept with this example. Okay, now one thing more important before understanding business entity concept, let us understand this example. Okay, now I'm talking of here owner and business. Okay, I just in previous video we discussed about that owner and business are two separate entities. They are not combined. They're not same. They are different entities. Okay, when owner contributes capital into the business, it is considered as liability for the business. Okay, now, that means the personal transactions of owner and the personal transactions of business are separated. Okay. Let us understand the personal transactions or personal expenses of owner. If you go out for a movie with your friends, let us say you spend rupees 2000 on popcorns and burgers and movie tickets. So what do you think, it is a business expense or a personal expense? It is a business expense or a personal expense? It is a personal expense, and it will be recorded in the owner's personal income or other owner's personal record book. But if you consider it as a business expense, okay, it will drastically reduce your profits of business every time you spend for your own personal use, like college fees for kids or house rent, etc. What does it mean? Why you think this kind of principle is introduced in accounting? Because otherwise there will be a wrong reflection of your profits. Because every time you do an expense, it is a personal expense or a business expense, if you record everything in the books of accounts only, in your business books of accounts only, obviously your profits will drastically reduce, and you will not be able to come to know that actually what are the business expenses and what are the owner's expenses. Okay, so they will combine together and give you a wrong reflection of the profitability of the business. So that is why it is always considered that the owner's expenses and the business expenses should be considered separately, and we should be written in the separate books. Okay. Now, let us understand it with a different way. Now, business transactions kya hote hain? They are the personal transactions of the owner, going for a movie or paying the college fees of the kids or house rent. Okay, they are the own personal expenses, not related to the business of the owner. But when you talk of business transactions, what are the business transactions now? Paying rent of the building where the manufacturing or the production is taking place. That is actually a business expense, because it is it is actually contributing in the business. It is actually contributing to your revenue. Okay. Now, paying salaries to the employees also considered a business expense, because obviously it is a part of business only. Selling goods to customers is a part of business. Purchasing raw materials on credit from a company is also a business transaction. So understood the difference between personal transactions and business transactions, right? Now, next thing is, what is business entity concept? According to this concept, business is considered separate and distinct entity from its owner. That is all right. All the personal expenses, now understood, all the personal expenses and incomes of the owner are considered separate from the expenses and incomes of the business. Okay, this we have discussed, right? All the entries which are recorded in the books of accounts must be recorded from the point of view of business only, not the owner's point of view. What does it mean? That means though it is a business of the owner only, but still you keep a separate record of the business transactions and the separate record for the owner's transactions. If the owner now, if owner is doing something for the business, that will be written in the business books. Okay. Now, owner is investing capital into the business. The owner is a kind of third party to the business. Okay, and it is considered as a liability of the business towards the owner. We have discussed this, because if owner is contributing some capital into the business, obviously it will get the interest on that capital from the business. You invest. Now let us see with a simple example. Suppose you make an investment into some company, you will get the returns or you get the interest out of that. Okay, so this is the same thing as for the owner also. That is, if the owner invests capital into the business, it is considered as a liability of the business towards the owner. Now, business is liable to pay money to the owner to the extent of its capital. That is, owner is considered as a creditor to the extent of his capital. Creditor means the person, that is basically the business. When the business owes money to third party, that is the person to whom business owes money. Creditor means what? the person or the entity to whom business owes money. Now here business owes money to the owner. So owner is considered as a creditor to the extent of his capital. Now Mr. Sahu started business investment at 1 lakh, goods 40,000, furniture to 20,000, plant and machinery 30,000, cash in hand 10,000. 1 lakh will be considered as the capital of the business of the, that is the liability of business towards the owner. Okay. Now this is the total segregation of the amount. Okay. This segregation is a segregation of 1 lakh. So invested total 1 lakh into the business. So this 1 lakh means now it is a liability of the business towards the owner to pay the return to the owner. That is to pay the interest on capital to the owner now. Okay. Now next. Now, another thing, I told you that we have to record everything from business point of view. If owner is doing something for the business or if owner is doing something, withdrawing something from the business, it is a business transaction only because business is involved over here. If the owner withdraws money from the business for his own personal expenses, it will be considered as a drawings made by the owner. We have discussed this in the previous videos. Now, we know this drawings means owner withdraws something from the business. That means it is affecting the capital of the firm obviously and thus reduces the liability of the business to that extent. Okay. That means if you remember the drawings part of the balance sheet in the previous video, we discussed that drawings are shown in the balance sheet. Under the capital section, you write capital. Suppose capital was 85,000. So drawings was made 10,000. So we'll subtract from the capital drawings of 10,000. The amount is 75,000. Written in the balance sheet. It shows you that a business is liable towards the owner to the extent of only 75,000 because 10,000 has been taken out by the owner from the business. So business is not liable for the 10,000. Okay. Now, suppose the transactions of the business must be kept separate from the personal transaction of the owner. Now, the owner of the business took 200 rupees out of the firm's cash registrar to buy some clothes for the party to attend on the weekend. Now, this is a personal expense. It will not be recorded in the accounting books. Okay. It is our expense for the business. Answer is it should be recorded as a personal transaction of the owner because it is not a business expense. It is a drawings made by the owner for personal use. Now, what is the significance or what is the significance? That is, it is a very basis of all the accounting concepts, conventions and principles. Without this concept, studying all the other principles or conventions and concepts is all in vain. Okay, because without this concept, all your general, your ledger accounts, your trial balance, your balance sheets, your profit and loss statements will be affected very much drastically because if you enter the wrong transactions in the books of accounts. So if you enter the proper transactions in the books of accounts, then only you make the ledger properly, you make the journal properly, you make the trial balance or balance sheets or profit and loss statements properly. Okay, without any kind of bias. So that is why this concept helps in ascertaining the true picture of the profitability of the business because only the business expenses and revenues are recorded in the books of accounts, not the private transactions of the owner. Now, what is the important note? What is the conclusion of this business entity concept? Now, this is very, very important. Now, business is liable to pay interest on capital to the owner. You agree with this because you discussed right now. Okay. And interest on drawings is charged from the owner. Now, since the owner is withdrawing something from the business, the owner is withdrawing the capital from the business, it is liable to pay the interest on drawings to the business. Owner is liable to pay the interest on drawings to the business. Okay. This is a very beautiful concept explained over here. So just go through it and thank you everyone. Thank you for watching.